Hey there, second video. And remember, I'm not your lawyer. Today we're talking about real estate and a 1031 exchange. A 1031 exchange is one of the most useful tools for real estate investors to defer taxes when selling an investment property. But there is a lot of confusion about how it works, and even more confusion about whether you can take any cash out of the deal without triggering taxes. The answer, yes, it is possible if you follow the rules and understand the strategies. Let's break it down. When you sell an investment property for a profit, the IRS charges you capital gains taxes on that profit. So let's say you bought a property for $200,000 and you sell it for $300,000. That's a $100,000 difference, which is your capital gain. The IRS calls it that because it's a gain on your capital, the money you've invested in an asset like real estate, stocks, or other investments. Capital gains taxes are essentially the IRS's way of taxing your success or taking a percentage of your profit you make when you sell a property for more than you bought it. Depending on how long you've owned the property and your tax bracket, the percentage you owe can be significant, sometimes 15%, 20%, or even more. Now, a 1031 exchange lets you avoid paying those taxes immediately. Instead, you reinvest the profit into a like-kind property and the IRS defers the taxes. Like-kind property just means the property you are buying is also for investment purposes, not for personal use. So if you sell a rental house, you could reinvest into another rental house, an apartment complex, or even a piece of commercial property. It doesn't have to be the exact same type of property. It just has to serve the same purpose as an investment. And the key word here is defer. The taxes are not erased. They are just postponed to a later time, like when you sell the replacement property without doing another exchange. Now, if you don't reinvest all the money, what if you like to pocket some of the profit? That's where the concept of boot comes in. Boot is just a term for any part of the proceeds from the sale that does not get reinvested. It could be cash you take out or even a reduction in debt if you don't replace the old loan with one of equal or greater value. Whatever the case, that boot is taxable. It's treated as income and you'll pay capital gains taxes on that portion. For example, say you sell a property for $500,000 but only reinvest $400,000 into the replacement property. That leftover $100,000 is boot and you'll owe taxes on it. Boot is not just about cash though, it can also happen with debt. Let's say the property you sold had a $300,000 mortgage, but the property you are buying only has a $200,000 mortgage. That $100,000 difference is treated as boot because it reduces your reinvestment. The IRS sees it as you taking profit from the transaction, even if you didn't physically take out cash. Now let's talk about loopholes. What if you need some cash from the deal and don't want to pay taxes on it? This is where refinancing comes into play. If you refinance before selling the property, you can take out equity in the form of a loan. Since loans are not income, they are not taxable. For example, if your property is worth $500,000 and you owe $200,000, you might refinance and take out $100,000 in cash. Then you sell the property and use the remaining proceeds in the 1031 exchange. The $100,000 you took out is not considered boot because it wasn't part of the sale. It was a loan. However, this strategy can raise red flags with the IRS if it looks like you only refinance to avoid taxes. Timing and intent matter here, so it's best to talk to a tax professional before trying this. Another option is refinancing the replacement property after the exchange. Once you've completed the exchange and own the new property, you can refinance it to pull out equity. Again, this is considered a loan, not income, so it's not taxed. This is often safer than pre-exchange refinancing because it's harder for the IRS to question your intent. Either way, refinancing is a great tool for accessing cash while staying within the legal boundaries of the 1031 exchange. Just make sure you're working with a tax professional to avoid any red flags. Let's talk about depreciation and how it affects taxes. Depreciation is a tax deduction the IRS gives you because properties wear out over time, or at least that's the idea. For residential rental properties, the IRS lets you depreciate the value of the building, not the land, over 27 and a half years. For commercial properties, it's over 39 years. This means you can deduct a portion of the property's value every year, which lowers your taxable income. Here's why this matters in a 1031 exchange. If you've owned a property for a long time and claimed depreciation deductions, the IRS requires you to recapture those deductions when you sell. Depreciation recapture means you'll pay taxes on the amount you deducted, even if you deferred the capital gains taxes through a 1031 exchange. But if you structure your exchange properly, you can roll that recapture tax into your new property, continuing to defer it. You can also take advantage of cost segregation to accelerate depreciation by breaking the property into components like the building, appliances, or landscaping. You can depreciate some parts faster than others. This creates larger deductions up front, which can help offset taxes if you have any boot from the exchange. Now let's get into qualified intermediaries, or QIs. These are absolutely essential in a 1031 exchange. The law requires that you use one to handle the proceeds from the sale. The IRS has a strict rule. You're not allowed to touch the money from the sale. If the funds even hit your account for a second, the 1031 exchange is disqualified and you'll owe taxes on the full amount. So a QI acts as a middleman who handles the money from the sale of your old property to the purchase of your new one. When you sell your property, the proceeds go directly to the QI, not to you. They hold the money while you identify your replacement property. Once you've made your choice, the QI transfers the funds to complete the purchase. This ensures that the exchange stays within the legal guidelines. Choosing a reputable QI is critical. They must be an independent third party. They can't be your lawyer, real estate agent, or someone you're closely connected to. A good lawyer can review your QI agreement to make sure your money is safe, because if something goes wrong, like the QI mishandling funds, the consequences fall on you. The 1031 exchange is one of the most powerful tools for building long-term wealth in real estate. You can keep rolling over your gains into bigger and better properties, deferring taxes as you go. And if you hold on to the property until you pass away, your heirs can inherit it with a stepped up tax basis. That means they won't owe taxes on the deferred gains, which effectively eliminates the tax altogether. Let me know your hate comments below. And if you wanted me to expand on anything in this video regarding a 1031 exchange, I'd be more than happy to do another video on that. Just let me know in the comments below. Also, one last thing, let me know if you prefer edited videos with a lot of visual aids and more edits, or if you don't mind that it's just me talking. So thanks for watching.